They're calling it a total disaster, and for once, they're not exaggerating. A brand new HMRC rule has just come into force, and it could cost thousands of UK families everything they've worked for. We're talking about ordinary homeowners, not millionaires suddenly hit with massive tax bills just for trying to pass on their family home. If you think inheritance tax doesn't apply to you, think again. Because under this shocking new rule, even your house, your savings, and your children's future could all be at risk. And the worst part? Most families won't realize it until it's far too late. Inheritance tax, often shortened to IHT, has long been one of the UK's most unpopular taxes. It's the so-called death tax, the levy applied when someone passes away and their estate is transferred to their loved ones. For decades, the government has said it only affects the rich. But that's no longer true, because with house prices skyrocketing and tax thresholds frozen, more and more middle-class families are being dragged into the inheritance tax net. And now, HMRC's latest rule change could push even more ordinary households over the edge. The controversy began when the Treasury confirmed it would not raise the IHT threshold, the amount you can pass on tax-free, for the foreseeable future. That threshold, called the Nile rate band, has been stuck at £325,000 since 2009. Think about that for a moment. Back in 2009, the average house price in the UK was around £157,000. Today, it's more than £280,000, and in London and the South East, far higher. Yet the threshold hasn't moved an inch. That means what used to be a tax for the wealthy now hits average families. Add in the new rule, HMRC, just introduced, and things are about to get much worse. Under this new rule, HMRC is tightening how certain trusts and family transfers are treated when someone dies. Previously, families could use trusts, gifts, or inheritance planning tools to reduce their IHT liability legally. But from now on, many of those legitimate methods are being reclassified, meaning the assets could be taxed not once, but twice. Yes, you heard that right. Assets that families thought were safe because they were moved into trusts years ago could now face new scrutiny under HMRC's updated interpretation. Financial advisors are warning that this could lead to unexpected bills for executors, the people handling estates after death, who could now be liable for unpaid tax if they didn't anticipate the new rule. One London-based tax expert didn't mince words. He said, "This is a total disaster for UK families. HMRC is effectively punishing people for doing the right thing, for planning ahead, for saving, for wanting to give their children a better future." It's estimated that this rule could raise hundreds of millions in additional tax revenue, mostly from ordinary families who've built modest estates through hard work and home ownership. So how exactly does this play out in real life? Let's look at an example. Imagine a retired couple, John and Margaret, who bought their home in the 1980s for £75,000. It's now worth £650,000. They have 2 children and a few savings, nothing extravagant, but a lifetime of effort. When John passes away, Margaret inherits everything. No tax there, because transfers between spouses are exempt. But when Margaret passes away and leaves the estate to her children, things get complicated. Under current rules, their total estate value, the house, savings and investments, could easily exceed £650,000. Subtract the £325,000 tax-free allowance and perhaps a bit of residence Nile rate band, if they qualify, and the rest is taxed at 40%. Now, under the new HMRC interpretation, if they'd moved part of the estate into a trust, something once encouraged by financial planners, the trust could now be counted within the taxable estate. That means even more of their money gets taxed, even though it's already been taxed once before. The result? their children could lose over £100,000 in inheritance tax. And that's not an exaggeration. It's a reality more and more families are facing. Critics say the government is effectively using fiscal drag freezing thresholds, while prices and inflation rise to quietly increase tax revenue without ever admitting it's a tax rise. And for families in regions with strong property markets, London, Surrey, Kent, Bristol, or parts of the Midlands, it's devastating. A modest 3-bedroom semi that once sat safely below the tax threshold is now enough to trigger a major inheritance tax bill. One retired homeowner summed it up perfectly. "We worked all our lives, paid our taxes, and just wanted to leave our home to our kids. Now, it feels like the government wants a chunk of that too." So why is this rule being introduced? According to HMRC, the change is designed to close loopholes and ensure fairness in the tax system. They claim some wealthy individuals were using complex trust structures to dodge inheritance tax altogether. And while that may be true for a small number, financial analysts argue the vast majority of people affected will be ordinary homeowners, not millionaires. One former HMRC official even admitted off the record that these rules are easier to enforce on middle-income estates than ultra-wealthy ones because regular families rarely have the means to hire top tax lawyers. So, what can families do to protect themselves? Experts are offering several key pieces of advice. First, review your will and estate plan immediately. Many people have wills written years ago, based on old laws or tax assumptions that no longer apply. Even a small change in wording could determine whether part of your estate falls under this new rule or not. Second, get professional advice before gifting large assets. There used to be a simple rule: if you gave something away and lived 7 more years, it was tax-free. But under the new guidance, HMRC may now assess how and why the gift was made and whether it was truly out of your estate. Third, consider using your allowances each year. Every person in the UK can give away £3,000 annually without it counting towards IHT. It's not a huge amount, but over time, it can make a difference. And finally, keep records. HMRC is increasingly requesting proof of gifts, transfers, and trust arrangements, sometimes dating back more than a decade. The more documentation you have, the better protected your family will be. Of course, there's also a growing political debate. Some MPs are calling for the entire inheritance tax system to be reformed. They argue it's outdated, unfair, and increasingly targeting the wrong people. In fact, one recent poll found that over 60% of UK adults now believe inheritance tax should be abolished altogether. Even within government circles, there's division, with some Conservative MPs pushing for a complete overhaul, while others argue it's necessary to maintain public finances. Meanwhile, Labour has hinted that if they come to power, they may review the system, but many fear that could mean even higher taxes rather than relief. Either way, the uncertainty is making families anxious. What's clear is this: the inheritance tax system, once meant to target extreme wealth, is now a burden on the middle class. And HMRC's latest rule change just made that burden heavier. For millions of UK families, the dream of passing on a home or modest savings to their children is slipping further away. Instead, they're left navigating a maze of paperwork, red tape, and unexpected tax bills. Thanks for watching UK Insight Now. Don't forget to like, subscribe, and share with other seniors who need this info. See you in the next video. Stay well, stay informed.